Okay, can you all see the presentation?
Yes, sir.
Yes, sir.
Okay, can we proceed? Okay, good morning, everyone. Let me take you through the final parts of my, areas of the course. Today we will look at the Basel framework, that is basically what is presently, in place, that is Basel 3, but we start with a brief introduction of Basel 1 and then Basel 2 and what exactly appearing in Basel 3. So basically, if you look at Basel C, Basel is, related to risk. Where at the end of the day, in any bank, what is most important is you have adequate capital buffer and capital base to meet the risk arising from day-to-day activities. So the purpose of Basel Accord is bringing an international standard across the banks or international banks applicable in all countries, so that there is uniformity in application. So, and also it is very much easier for comparative purposes. So if you go back to the history, that is Basel 1, is the round of deliberation by central bankers from around the world, and in 1988, the Basel Committee on Banking Supervision in Basel, Switzerland, published a set of minimum capital requirements for banks. So in fact, at that time, that is called Basel Accord, but not Basel 1, but subsequently, with the amendments took place or changes to the relevant capital adequacy ratios and the requirements, then this was named as 1, 2, 3. So originally it was Basel Accord, which came into effect in 1988. So as you know, in mid-70s, okay, or maybe that is the decade of 70s, where the banks were subject to, international banks were subject to significant risk. And also, as a result, their capital went down, and even leading to some insolvencies, so that the regulators around the world, thought about bringing some governance structures through the capital adequacy framework to ensure systemic stability. Okay, so there were a couple of failures, big failures in Germany, State Bank, if you can recall, the State Bank, and then also I think one the Italian or French bank, so which collapsed. So that led to the international regulators to discuss amongst themselves how to bring in some standardized way of enforcing capital. So there were several views, ideas expressed, and in 1988, all got together in Bank for International Settlements. I think all of you know in what is called BIS. BIS means for Bank for International Settlements, which basically act as the central bank for all the central bank, like the parent. So, which sets the all regulations relevant to financial system stability and related areas. So, if you look at Basel, is where BI is located. Basel is a city in Switzerland, and it is located. BI is located in Basel, so that's how it came Basel Accord. So they are the primary focus at that time, because if you look at her State Bank and another bank in France, which collapsed mainly as a result of credit risk. So at that time, 70s, early 80s, the most stringent risk faced by international banks around the world was the credit risk. So then regulators in 1988 came up with a model which says, okay, to manage or to mitigate any risk arising from credit risk, you need to maintain a particular benchmark of capital level. Okay, so basically to cover credit risk. So they introduced two ratios, what is called core capital adequacy ratio and the total capital adequacy ratio. I will come to the details, what is available now later, but for the beginning, so the two key ratios are the core capital adequacy ratios and the total capital adequacy ratio. So at that time, so they define what is core capital. I will come to the core capital components, what is available in the Basel III, because no point of talking what was considered in Basel I. And there is another component called supplementary capital. So which we will discuss towards the latter part. So you have the core capital, which comprise of several elements, where the Basel allowed the bank to take in. Then you have supplementary capital. We also call core capital as tier 1 capital. Then supplementary capital as tier 2 capital. So if you look at the tier 2 capital, which is not part of solid capital. Now, if you look at core capital, as per the classification, this is very strong capital in a bank. Now, of course, under Basel III, it is further divided into common equity tier 1 capital and tier 1 capital. But at the beginning, we had only two components, core capital and supplementary capital. So when you add core capital and supplementary capital and with some adjustments, Basel suggested some adjustment. I'm not going to discuss at this moment, but later, you arrive at the total capital, right? So you have the core capital in the bank. The Basel specified, okay, what are the components of core capital? Then you have supplementary capital. So Basel defined these are the elements you can take as supplementary capital. Then there are some adjustments, if you have to do. Then when you deduct or add or whatever you do from the basically deduction from the, those two, you arrive at the total capital. So then for the credit risk, because at the beginning, it's only credit risk which covered, then the Basel assigned for each element of asset in the balance sheet a particular risk weight. So now RWA stands for risk-weighted assets. Risk-weighted asset. So depending on the credit risk nature of the asset, Basel came up, or recoverability came up with some weights. Now risk weights is moving from 0, 10, 20, 50, and 100. But now it's a little different. So we will come to, when we discuss the Basel III in detail, what is presently, applicable. So I will go into detail, but not here. So each asset is given a risk weight from 0, 10, 20, 50, 100 based on the credit risk. Now, for example, now, if you look at a particular, now, can you think of a asset in the balance sheet of the bank? Now, here the risk weight means from the point of credit risk, the default risk, right? So, can you give an example now where in a particular asset which can have a 0 risk weight? 0 risk weight.
Treasury bills.
Huh? Yes, I couldn't hear properly. Can you tell example? Which carries a risk 0 risk, probable 0 risk weight. Now here the credit risk. Anyone?
cash.
Cash. So why do you say cash is zero?
Because basically it doesn't have like link risk like credit risk or any default risk because purely we are just keeping cash as cash within
Okay.
the institution
Yeah.
itself.
Yeah. So cash, because it is something you hold in your walls. So there is no credit risk. It's with your hand. Credit risk is basically when you grant a loan, the probability that the whoever who borrowed from you will repay. So what is available in your cash, what is in your hand, which is cash, basically credit risk is zero. So likewise, the Basel assign, okay, these are the assets which can apply a credit risk of 0%. These are the assets which can apply credit risk of 10%. These are the assets you can apply credit risk of 50% and so on. Okay. Now, for example, now if you look at a mortgage-backed housing loan, mortgage loan, basically Basel suggested mortgage-backed housing loan risk weight is 50%. It's not 100%, 50%, right? But if you look at a complete unsecured loan, the Basel said your risk weight is 100% because they thought that has a almost 100% equivalent credit risk. But if you have a loan pledged with gold or something, they said, okay, your risk weight is this much. So basically, then the very simple formula. So it is given. The bank does not have to worry. It is given by the Basel. Okay, all assets. Okay, this sort of asset in your balance sheet, if you have, apply a 0% risk weight. So what does it mean? If a particular asset is 0% risk weight, so alternatively, what does it mean?
There is no any default risk.
Sorry? Yeah, that's right. But what I'm saying from the point of view of capital, what does it mean? From the point of view of capital, what does it mean if a particular asset has zero risk weight? Can someone tell? So if a particular asset has zero risk weight means, so what is the total risk weighted asset value? Let's say you have, now you said cash is zero risk weight. Let's say you have 100 million cash in your balance sheet as at a particular date. So if it is zero risk weighted, what is the value of risk weighted assets?
Zero.
Zero, because the value of the asset multiplied by the risk weight is the risk weighted asset. So if it is 100 million, risk weight is zero means 100 multiplied by zero is zero. So what does it mean? If the risk weighted asset zero means you don't need to maintain any capital, right? Because you are well covered in terms of credit risk. Now here the idea is how much you require to maintain capital in terms of risk-weighted assets. Okay, so basically, as far as zero risk-weighted asset concerned, you don't have to maintain any capital. So that's the basic idea. So let's say you have asset worth 100 million, same asset, but 100% risk-weighted. 100% risk-weighted. Okay. So then how much capital you are required to make for that asset?
100 million.
Capital, I'm asking capital. The risk-weighted asset value is 100 million, right? Because 100% means 100 million. So how much capital you need? Let's say co-capital. How much capital you need? Anyone? How much capital you need? You have two ratios, core capital and total capital. How much core capital you need? How much total capital you need?
It's 4 million as per the Basel one for the core capital and 8 million for the total capital.
Okay. So Basel says if you have a risk-weighted asset, you need to have at least minimum 4% core capital for particular asset. If you have a total capital, at least 8%. So if you take a 100% risk-weighted asset, that means if your exposure is 100 million, so that means your risk-weighted asset value is 100 million. Earlier 0, so you don't have to maintain any capital. So 100 million of 4% is 4 million. So basically, if you have a particular asset 100% risk-weighted, then so you have to apply the value 100% multiplied by 4%, that is 4 million core capital. For the total capital, you need to maintain 8 million. So that is the basic structure of the Basel. So in a balance sheet, you have, let's say you have 1,000 odd assets. So each asset is given a risk weight, 0, 10, 20, 50, 100. Then you simply what you do is, from a bank point of view, you multiply your value of the balance sheet value by the particular risk weight, 0, 10, whatever. Then you arrive at the risk-weighted asset value. So that is what is called the risk-weighted assets value in the entire balance sheet. I gave two individual examples. So you do it for each and every asset and you come up with the total balance sheet risk-weighted assets. Then you know what is your core capital. Again, Basel defined, okay, this is the core capital. These are the elements eligible for core capital. So that you take those values, then what you do is you take core capital divided by the risk-weighted asset, then you see what is your core capital adequacy ratio. The Basel said, okay, to mitigate the risk, okay, you should have at least 4%. Now, let's say when you compute your core capital of the bank is, let's say, 45 million, and the total risk-weighted asset value is 1,000 million. So what is the core capital adequacy ratio? When you take your core capital components, the value is 45 million, and the total risk-weighted asset value is 1,000 million. So what is the core capital adequacy ratio? Anyone? Very simple.
4.5%.
4.5%. So your core capital adequacy ratio is 4.5%. So that means you are, in terms of Basel capital adequacy ratio, you are Basel compliant. Okay. So similarly, if you take the total capital, now total capital is a combination of core capital and supplementary capital. We will discuss them towards later because I'm not going to discuss here. So that it's a combination of core capital and supplementary capital and some adjustments. Then you arrive at the total capital. Again, when the total capital divided by risk-weighted asset, whatever the ratio should be basically more than 8%. So that's what the Basel said. So this is how the Basel came into effect in 1988. The focus is only credit risk. Okay. But then subsequently, as I mentioned here, now during the 90s, you know, the decade of 90s, the banks were subject to certain other risk categories, especially the market risk. I think we have, probably you have done the credit risk in this particular course. We have done the market risk to a great extent. So the banks were subject to greater level of market risk in addition to the credit risk, right? So then in 1996, as I highlighted here, the Basel added the market risk component also into the framework. Okay. So by 1996, the Basel I covered both credit and market risk. Okay. So let's move on to Basel. Are there any questions? Anything you need clarification? Okay. Now, while the Basel is in, even in Sri Lanka, we applied Basel I framework around 1996, as I understand. But then Basel II capital adequacy framework, the aim of Basel II capital adequacy framework. Now, despite Basel I was there, you see, the regulators around the world and the Basel Committee felt that there are other risks which are prominent, such as operational risk, and also you need to look at a somewhat macro framework about the Basel capital framework, not just the ratios. Okay, I mean, it's not appropriate to confine your entire capital base only by looking at particular risk and calculating the capital adequacy ratios for those risks. So that's why in 2004 there were a lot of discussions in the Basel Committee, and it came into effect. And beginning from 2006, which is called the Basel II Capital Adequacy Framework. So the idea was, as I given here, ensure that capital is held against the most significant risk that face. Okay? Significant risk that face. That is readily quantifiable, right? Ensure that capital is held against other risks where needed. Even though numerically you say you need the Basel covers credit, market, and operational risk, but there are a lot of other risks which you may not measure in terms of a ratio, but a bank should sufficiently have sufficient capital to cover up those risks. Okay? So they make the capital allocation more risk sensitive. Okay. Now, then again, this concept of economic and regulatory capital came into force. So what it says, align economic and regulatory capital more closely. Now, what do you mean by economic capital? What do you mean by regulatory capital? Now, earlier we looked at Basel recommended two ratios, core capital adequacy ratio and total capital adequacy ratio. Those are the regulatory capital requirements. So the regulators say, now if you look at Sri Lanka, we have a somewhat different level we apply here compared to the international. International standard is a minimum, right? International standard is a minimum. But the respective central banks in the respective countries can decide anything more than that depending on their environment. Okay, the broader level of risk, right? So regulatory capital is this 4%, 8%, 5%, 10%. Now, whatever is called the regulatory capital. So what do you mean by economic capital? Now, regulatory capital captures only few risks. Now, if you look at the original Basel I, it is only credit risk. And subsequently, it went to cover the market risk. Now, under Basel II, it covers operation risk as well. But in fact, what is important is, okay, you should have the minimum regulatory capital, that is minimum. But what is important is, as the risk managers, okay, well, banks are taking huge risks, you should be able to identify your own strengths, own risks, and decide what is the right capital for you on top of the regulatory capital. So that is called the economic capital, right? So that is up to you, okay? I mean, when you comply with the regulatory capital, basically regulators are happy because you have complied with the regulatory capital. But is it sufficient? So who should decide it? It is you, the bank. So you decide what is the ideal capital for me on top of the regulatory capital. Because regular capital is a must by the regulators, but as a banker, you must decide what is the right capital for you. Then enhance disclosure requirements to allow market participants to assess the bank's capital adequacy. I will come to that slide shortly. So under Basel II, there are three pillars we are talking about: Pillar 1, Pillar 2, Pillar 3. So basically, the Pillar 3 is about the disclosure requirement. So the Basel suggested you must disclose to the market, to the public, about certain risk elements of your bank. So, and the capital adequacy. So the market participants are aware of the risk, and that will help them to take appropriate business decisions. For example, when a particular bank publishes data, the market participants are supposed to look at them. If they look at, they can decide the risk, and they can decide, for example, let's say there are two banks. I find one bank is capital adequacy ratio is maybe total ratio is 8.5%, but another bank is 10.5%. So in terms of capital adequacy ratio, which bank is stronger? Bank 1 or Bank 2? One is having 8.15% core capital, sorry, total capital. Other bank is having 10.5 total capital. So which bank is stronger?
Second bank.
Second bank, it has a higher capital adequacy ratio. So the minimum is 8%, but it has 10.5%, which is much stronger. So definitely a natural person may tend to take a decision, okay, am I going to invest in this particular bank or the other bank? So it gives some, ability for the market participant to decide on the risk elements of the bank and take appropriate decisions. Okay. So that is the purpose of, Pillar 3. We will come to that later. So basically, as I mentioned, the Basel II structure is three pillars. That is minimum capital requirements, the supervisor review process, the market discipline. So if you look at minimum capital requirement, that is same as what we discussed earlier. Because minimum capital requirements means you take your core capital, you take your total capital and divide it by the risk-weighted assets, right? And you see whether you can maintain anything above the specified minimum, right? So that is the objective of minimum capital requirement, which we already discussed. So there you have two components: quantifying capital, that is core capital, and supplementary capital, and the total capital. Then the risk-weighted asset. Now, of course, under the Basel II, Basel I, it's only for the credit risk. But then, 1996, the market risk was brought in. It added operational risk. But the Basel went a little bit further. Instead of, even for the credit risk, instead of, specifying the risk categories like 0, 10, 20, 50, 100. So Basel went a little bit detailed, giving certain models or the certain approach for a bank to take a decision, and also regulator to take a decision how they are going to apply in their respective countries. So there were two approaches, the broad two approaches, but in fact three approaches. For credit risk measurement, standardized approach, internal rating-based approach. For the operational risk, also three approaches: basic indicator approach, standardized approach, advanced measurement approach. And for the market risk, the same two approaches, the standardized approach and the model approach. So I am not going to discuss very, very detailed technical, because this is, what I want to emphasize is, overall how the Basel captured the different risks. So we are not going to discuss very detailed technical part. When we come to Basel III, we will go through the present directions, how it applies. So these were the different methods Basel suggested to come up with the credit risk, market risk, and operation risk components. So in addition to so that basically formed part of the minimum capital requirement calculation. But then it came with another pillar. So that's why three pillars. called supervisory review process and the market discipline, which we will look at differently. So now I mentioned earlier, the Basel II recognized the importance of regulatory capital and economic capital. So the concept of economic capital is addressed under this component pillar. And I mentioned earlier, very last point in the last slide about the disclosures. The disclosure part will be covered under the market discipline. Okay. So basically, if you recap what we did, okay, the pillar 1, the minimum capital requirement covers 3 risks: credit, market, operation. So supervisory review process. Now, supervisory review process, even though it's not quantifying as per a definition given under pillar 1, but it tried to measure any other risk not covered under pillar 1. Even under pillar 1, what is covered but not fully covered. We will come to that later. So the pillar 2 objective is to look at the risks which are not covered under pillar 1, even if it is covered under pillar 1 but not fully covered, and see whether the present capital is adequate. So which is the economic capital? Remember economic capital I mentioned? Then the third pillar, as I mentioned, the market disclosure, so that the market participants are thorough with the bank's risk and the capital adequacy. Right? Okay. So as I already mentioned, the pillar 1 determines the minimum level of capital a bank should hold as a buffer for those levels, right? Is it moving now?
Yes, sir.
Huh?
Yes.
Okay. Now it's okay, no?
Oh, yes, sir.
Okay. Okay. So this is Basel II structure I explained. Can you see this?
Yes, sir.
Okay. So we were here. So basically the 3 approaches for the credit risk, the advanced internal rating, IRB stands for internal rating based approach. Then there are 2 ways you can measure. We are not going to too much technical. I will explain a little bit towards the latter part. Then there are 2 approaches for the internal rating based approach. There are 2 ways: the advanced approach and the foundation approach, and the standardized approach, which is mostly used in Sri Lanka. The standardized approach. Some of you are in the particular area of your job probably would know in detail. Then operation risk, there were 3 approaches the Basel suggested. The basic indicator approach is the very simple approach, the last one. Then standardized approach and the advanced measurement approach. Most banks in Sri Lanka, they follow the basic indicator approach. Probably, maybe some international banks follow standardized approach. Then market risk, there were 2 models suggested, standardized and the internal model based approach. But here in Sri Lanka, mostly follow the standardized approach, right? So let's move on to the credit risk part and the standardized approach. So what do you mean by standardized approach? What was the idea behind that? Now, if you look at the Basel I, the credit risk, how did we measure the credit risk? Very simple. We compute the core capital as per the definition given by the Basel. We compute the total capital, and then we compute the risk-weighted assets based on the different risk weights given by the Basel, and then we compute the relevant ratios. Now, if you look at standardized approach, it is much similar, but instead of giving a particular risk weight for particular asset, the Basel suggested whether it's 0, 10, 20, 50, 100 or whatever, depending on the external rating. So the banks are required to get external rating for certain categories of assets, right? For the purpose of credit risk computation. In doing so, probably there are certain issues arise. So how do you exercise your national discretion? Because if you look at rating agencies in different countries, maybe a little bit different. So are we confining for an international rating agency or domestic rating agency? So it's up to the relevant regulators. Then reliance on external rating. What is the assurance that external rating will give a perfect idea about credit risk? Then credit risk mitigation. Okay, so whenever you have risk mitigation, how do you apply that? Now, for example, if you have a loan fully covered against gold, so there is a part of risk mitigation already there. So how do you apply it? Then again, the issues came up with respect to the MIS, Management Information Systems and IT capabilities. Okay, so those are the critical issues. But after careful analysis, I think most of the issues were addressed, and so basically, then it's a very simple approach. Most regulators has allowed banks to apply even in Sri Lanka. So this is called the standardized approach. We will look at the methodologies little later, as I explained earlier, not at this moment. So then IRB foundation approach. I think most, like many international banks around the world, basically follow this approach. This is a model-based approach. So where the capital is a function of the 4 components: the probability of default, loss given default, exposure at default, effective maturity. Essentially, if you look at IRB, it is something relevant to the credit risk models, where now many banks or the many auditors use for the fair value computation. If you look at for accounting purpose, your financial statements are based on fair values for your credit risk. So basically, those auditors will also look at your credit risk based on your financial model. So where I think most of these parameters will be taken into account, even though Basel came up with this much before. So there, if you follow this particular model, so it's a model-based credit risk approach. So you need to look at these 4 components: probability of default, loss given default, exposure at default, effective maturity. So under this approach, the required banks to demonstrate their internal systems to supervisors and subject to the validation and approval by the supervisors. So if a particular bank wants to follow this model, basically in terms of Basel requirement, you need to get the approval of the regulators so that regulators know your model is capable of giving accurate results. And the models themselves need to be validated. Then the other feature is, now we looked at the foundation, IRB foundation. So there's another one called IRB Advanced. So in the foundation model, the bank estimate the PD. PD means probability of default. And the supervisors, that means the regulator, if you look at Sri Lanka Central Bank, they should give the other 3 parameters appropriate for you: LGD, EAD, and M. So that's what is called the internal IRB foundation approach, right? Then the Basel went little beyond that, and Basel again mentioned about any bank that would like to follow IRB advanced approach can do so, subject to several conditions. Okay. Again, risk weights to be linked to the bank's internal ratings. Again, you need to look at these 4 parameters, PD. But the important thing is, now earlier, if you look at IRB foundation approach, the bank estimate PD and supervisors will provide right, what are the right numbers for other three parameters. But under the advanced approach, PD as well as LGD, EAD, and M are taken from the bank's internal system. So basically, regulators have allowed the freedom for the banks to decide on all these three parameters, which they use in the right model. Again, you have to get the approval of the regulators if you want to compute credit risk based on a much advanced IRP approach. Okay. So the bank will develop internal capital allocation system to supply all inputs. So those are the in very brief.
So excuse me,
Sorry,
what was M there?
the maturity,
Maturity.
maturity profile, effective maturity. Right. Then market risk, again, market risk, the two approaches defined. Okay, let's look at what do you mean by market risk under the pillar one. Now, this is very important. Now, even in your banks, sometimes the market risk is not rightly understood or understood. Now, market risk is defined as the risk of losses in on and off balance sheet positions, risk of losses in on and off balance sheet positions arising from movements in market prices. Okay, so the risks subject to this requirement are the risks pertaining to interest rate related instruments and equities in the trading book. You know, in a bank, there are, for the purpose of, market risk purpose, you name the bank balance sheet for two books, as two books. What do you mean by two books? One is the trading book, other one is the banking book. Now here, when you look at market risk for this purpose means interest rate related instrument and equities in the trading book. So there are elements or there are interest rate related instrument in the trading book as well as banking book. But for market risk pillar one computation, we only capture what is in the trading book. Equities also same. You may have certain portion of equities in the trading book, certain portion of equities in the banking book. Okay. So only what is in the trading book is considered for this purpose. Okay. Then foreign exchange and commodity risk throughout the bank. So it's irrespective of where it is in trading or banking. So throughout the bank, whatever the exposure as a result of foreign exchange and commodities you are holding, that risk is taken for the market risk. So basically, as you know, market risk, there are four components: interest rate, equity, foreign exchange, and the commodity. So what is relevant to interest rate and the equity is what is available or what is coming from the trading book. But for the foreign exchange, there is no difference, which is throughout the bank. So as I mentioned in the chart earlier, so two approaches, standardized and the internal model-based approach, which again, I'm not going to discuss here because if you read any direction, anything about computations, we will understand, but that is not our purpose because we want to identify how the Basel try to address the risk component. So when you look at the operational risk, now operational risk again definition is important, is defined as the risk of loss resulting from inadequate or failed internal processes, people and systems, or from external events. The risk of loss resulting from inadequate or failed internal processes, people and systems, or from external events. Right? So there are again three approaches: the basic indicator approach, standardized approach, advanced measurement approach. I think most bank here locally we follow the basic indicator, very simple approach. The standard approach is again it's an extension of basic indicator approach. There is no significant difference. We will discuss little bit. The advanced measurement approach is a much advanced approach, which is based on like the models in the other two risk categories. So, what is basic indicator approach? Under the basic indicator approach, the capital bank should hold to cover up the operational risk is defined as average over 3 years of a fixed percentage of positive annual gross income. So this fixed percentage is given as 15%, right? So basically what it says is you take for the past complete 3 years where your annual gross income is positive and take that average and multiply by, now of course, fixed percentage here is given as 15% by 15%, right? Clear? So you take the positive, now all these are defined. What do you mean by positive or the gross annual income? So you take the gross annual income of a particular bank over the past completed 3 years, take the average and multiply by 15%. So that is the capital charge required under the Basel II for operational risk. So very simple approach. Okay, so then we move to the standardized approach. Standardized approach where the same gross income is divided into 8 business lines. So let's say your gross income is 500 million. So the Basel has identified 8 business lines based on different activities. And Basel has said, okay, if you want to more fine tune your capital requirement, okay, you identify under which categories, so which business line these operational income has been generated. And Basel gives, okay, instead of 15%, depending on the business line, there's a different number. It could be 15, it could be, we will come to that later. It could be 18, it could be 12, and so on, right? So instead of taking the whole gross income for the entire bank and take the average and multiply by 15%, Basel say, okay, identify the business line as defined. Okay, so basically, there what we do is we take each business line, that is 8 business lines, take individual gross income of each business line for the past 3 years, take the average and multiply by the relevant factor. Now, earlier under the standardized, the basic indicator approach, we didn't segregate for the business line. We took the total, multiply the average by 15%. Now here Basel say, okay, if you want to further fine tune, okay, consider different business line, corporate finance, trading and sales, retail banking, commercial banking, payment and settlement, agency services, asset management, retail broker. So these are the business line. And for each business line, there's a beta factor given. Right? So the factors are, now if you look at corporate finance, they have given a higher factor. So that means they need a higher capital. If you look at retail banking, they have given a lower factor. That means you need only less capital. So whenever the beta factor higher, that means for those business lines, you need to maintain higher capital. For the lower beta factors means those business line, you need to maintain only a lower level of capital, right? So So this is the standardized approach. The standardized approach, second approach, which is extension of the basic indicator approach. And the third method, advanced measurement approach. Again, like the previous credit and market risk model-based approach, this is again measured by the internal operation risk measurement system or the internal model. Right? Internal model. But only problem with respect to this approach at the time, of course, now the banks are more comfortable, but at the time of implementation of Basel II was that at that time, if you look at credit risk, you have a lot of data. Any bank, if you look at credit risk, you have many data, much data about the defaults, who are the default, what were the ratings, and so on. If you look at market risk, you have a sizable quantum of data. But if you look at operational risk events, you don't have much data. So that was the problem at the beginning of Basel II, which was not, even though it was recommended, which was not, useful enough because the data was not available. Because if you want to measure the risk to a model, you need to capture the data when building up the model, right? So this was not very popular. Okay. So that is basically pillar one. Pillar one, we discussed three approaches. Sorry, three risks. So we looked at three risks: credit, operational, and market, and the different approaches as indicated here. Okay, any questions so far? Anything? I'm not going to discuss like the quantifications because probably you will, in your other courses, you will know about how these are quantified, calculated, but I am not going to discuss, but I want to highlight the theory behind this particular Basel concept and how the different risks are captured because risk is part of our course. Okay. Okay. Now we'll move to pillar two. What is pillar two? What is the pillar two? If you go back to your slide, what is pillar two? Supervisor review process. Pillar one, minimum capital requirement, which we discuss in detail, different methods, and how do you come to pillar two is the supervisor review process. So what is the idea of pillar two? The risk not taken into account at all under pillar one. So what are the risks taken under pillar one? What are the risks taken under pillar one?
Credit risk, market risk, operational risk.
Couldn't hear you properly. Is that duration? Yeah, if you could speak little loud, please.
Credit risk, market risk, operational risk.
Okay, the three risks which we covered under pillar one is credit risk, market risk, operation. That's right. So anything which is not covered, any risk not covered under pillar one will be subject to scope of pillar two. So can you give a couple of examples? Any such risk? Anyone? Any risk which is not covered under pillar one, possibly could take into account under pillar two? Come on, I mean, in a bank, are these the only risks you have? Any other risk probably would capture under pillar two?
Semantic risk.
Huh?
Semantic risk. This comes from the industry itself or the economic risk.
Okay. Okay.
Concentration risk.
Huh?
Concentration risk.
Yeah, concentration will be covered, but yeah, it's partly covered. Then any other risk?
Reputational risk.
Reputational risk, strategic risk, business risk. There are so many risks which a bank face. Okay. So all those risks are captured under pillar two. Then risks taken into account under pillar one, but not entirely. So these risks have already taken into account under pillar one, not entirely. Credit concentrations. Because if you look at pillar one, you take credit risk, but you are missing concentration or the mitigation. Okay. Now, if you little bit expand it, even interest rate risk in the banking book. Remember, pillar one under market risk, we only capture interest rate risk in the trading book. Remember, definition is very clear. Market risk also in open sheet. Risk per interest rate related to the trading book, equity trading book. So there may be interest rate risk arising from the banking book. Even to that, should be supported by capital if significant. See, even if it is in the banking book, but not captured on the market risk of pillar one, but if the bank feels it is significant, then you should have capital. Apply standardized interest rate shock. Banks with significant interest rate risk outliers should reduce risk, increase capital of both. Strategic risk. So many other risk type, strategic risk. Risk to the probability arising from wrong assumptions about external environment, economy, competitors, regulation. So if you feel you are subject to significant strategic risk, okay, provide or keep some adequate capital on top of the regulatory capital. Okay. Reputation risk arises when there is a group contagion or when there are potential reputation consequences from another receiver. Now the reputation risk arises due to a risk arising from another receiver. Now, for example, operational risk. Due to operational risk event, your systems go bust and probably then public will lose confidence because you don't have any backups or whatever. So as a result, you will subject to reputation risk. So operational risk itself led to a operational risk event led to a reputation risk. So the question is capital sufficient to cover potential reputation consequence of a market, credit, or operational risk event? Stress testing. So you can do stress testing. Again, question is operational risk. Is the pillar one capital outcome under basic indicator standard approach is sufficient? Remember, the capital is based on the gross income. If your gross income is low, naturally your capital adequacy requirement is low. Is it right? Whenever you have low profitability, low gross income, then your capital is low, required capital is low, then is it sufficient? So you have to think. Then, as I mentioned, the certain risks which are covered in the pillar one, but not fully, a specific risk is the credit concentration. Single exposure or group exposures that have potential to reduce losses large enough to threaten bank solvency. Okay, by the way, what do you mean by credit concentration? So what do you mean by credit concentration? Anyone?
Credit concentration is too much loans based on one category. For example, if we have mortgage loans, for example, if the bank have mortgage loans, personal loans, EPF loans, uh, term loans, so the total is totally depend on EPF loans or mortgage loans. The concentration is caused that.
Yeah, it's not just because of the loan, but if you are too much on a particular area,
Yes,
right?
sir.
Yeah, particular area. So if you have, let's say, out of your entire balance sheet, you have 50% mortgage loan, then it's a high concentration. If you out of your 100% loan portfolio, 40% in the real estate loans. So if there is a real estate bubble, there is a problem. Okay. Then if you have high even in a sector, for example, if you look at last couple of years, which were the most affected sectors if you have lended? What were the highest affected sectors in the economy?
Tourism,
Tourism.
tourism,
Huh? Sorry?
tourism,
Tourism. Now,
tourism.
yeah, tourism is a sector which affected significantly over the last 2 years. So the banks which have lent to the tourism sector would have, passing a very hard time. So if a particular bank has a high exposure, then it will be in trouble. Okay. So then the managing concentration also very important. So the pillar 2 says, look at the concentrations and see what are the risks arising. Then if so, then have more capital than what is required. Okay. A bank should, so to do that, bank should have internal system, policies and controls to identify, monitor and control concentrations. The concentration could be by the borrower, geography, industry segment, market segment, or product. Now, even now, if you look at the banks now, very recently, there's a significant risk because of the geography now, or the related products. What do you think? Which sectors? Which geography? Anyone? Can you think? Based on geography, we are exposing now. If you probably we don't know. Any examples you can think of? Very recent example.
See, because of the Russian and Ukraine war,
Yeah. How? Tell me how.
because most of the majority of our tea exports goes to Russia. So with this economic, that anyway, Russia is also having these inflation issues. So basically, with the war situation, those who are in the tea industry can face difficulties. So the lending by the bank to that industry, if their revenue goes down, the credit portfolios may affect.
Yeah. So if you have lent to the exporters who are in the tea export industry, where most exporters through the Russia will be significantly affected due to the war. Okay, so that's a risk which we never expected. Remember, which we never expected. So if you had the overly concentration among exporters, your main group is these exporters, then you will be in trouble. So that's why look at concentrations regularly, ensure you have adequate sufficient capital to meet such risk as well. But in general, it is always better have a less concentrated portfolio. So even if there is adverse situation, even you are somewhat comfortable, right? So these sectors would be hardly hit due to this particular war. If your bank has overly exposure, then again you will have to face that risk as well. So the bank should include concentration considerations subject to periodic stress tests in their ICAPs. We will look at what do you mean by ICAP. So the bank management continues to have responsibility for ensuring that bank has adequate capital to support its risk beyond the core minimum requirement. So that means Pillar 1 says regulatory capital minimum, but the management has a continuous, responsibility to assess the risks which are beyond the core minimum requirement. So we never know. Remember, we started the course with two things, very basic concepts. What are the very basic? When you talk about risk, two words we talk about. What are the two words? Two types of risk, two words represent the probabilities or possibilities, how we look at differently. What are the two? One is the risk. What is the other one?
Uncertainty.
Huh?
Uncertainty.
Uncertainty. So, okay. Tell me what is risk and what is uncertainty, which is more dangerous? From a bank point of view, what is more dangerous? Risk
Uncertainty.
event, huh?
Uncertainty. Uncertainty.
Uncertain. Risk event or uncertain event. Because if you look at the race, you have at least some data which you have factored into the historical data on which you have some probabilities of certain possible events. So you can measure the outcome with some certainty. But in a uncertainty, you don't have any possible, data, or possible outcomes and data. So the measuring is difficult. If you look at Russia and Ukraine war, if you factor that, it's something like this, a totally uncertain event. Even not here, anybody in this world would have not thought. No one would have thought Russian, taking control, and probably we yet don't know the next step. Maybe it may lead to a third world war. We don't know. That have much more repercussions. See, it's not just for the banks, for a whole world. Entire people in the whole world. So those are uncertainties. So that's why it is very important you have sufficient buffer, top of your capital, that is regulatory capital, to meet any such uncertain events, right? So supervisors are expected to evaluate how well banks are assessing their capital needs relative to their risk and to intervene when necessary. But capital should not be regarded as a substitute for addressing inadequate risk management process. So what is important is risk management process or the controls. I mean, you may not be, you can't be satisfied just because you have capital, but you put in place a good risk management process, right? And the controls. So under pillar 2, there are 4 principles. The 4 principles highlighted here: the bank's own assessment of capital adequacy, the supervisory review process, capital above regulatory minimum, and the supervisory intervention. So let's look at one by one. Okay, look at the first principle, the bank's own assessment of capital adequacy. So it's principle 1. What does it say? The bank should have a process for assessing their overall capital adequacy in relation to their risk profile and a strategy for maintaining their capital levels. Banks should have a process for assessing their overall capital adequacy in relation to their risk profile. and strategy for maintaining their capital levels. So it is responsibility of the bank to assess overall capital relation to their risk. So it's not just the pillar one, okay, pillar one risk, but beyond that, we discussed earlier. And also should have a strategy for maintaining their capital. You may have sufficient capital right now, but you need to ensure you maintain that at a comfortable level. Because we never knows at what point of time a particular risk hits. You see? So it's not just for the bank, any area that can affect. You see? Okay. So, so there are some principles involved with that. Now, the bank's own assessment of capital adequacy, how do you assess? Tailored to the bank's activities and the risk involved in these activities. There is no best practice with regard to design and implement. No one size fits all. So if you do two banks, it is not the same. So there is no defined way which say how do you assess. It's your own way. The methodology followed in the bank A may not be ideal for the bank B. So you as the bank need to look at your risk and decide whether you are comfortable. So that's why no one size fits all. It's a tailor-made process. So the bank A look at its risk and decide, okay, what is the right level of capital required for me? The bank B should look at its own, assess risk, the level of controls, and see what is right level for me. Even for two similar banks in terms of size, it may not be different. It may be different. That all depends on internal processes, controls, risk management process, and so on. However, there are some key features that should be included in every bank's ICAP. So what do you mean by ICAP? This is a document which you submit for the regulator periodically, giving detailed assessment of your risk. We call internal capital adequacy assessment process, ICAP. So I have briefly summarized, I am not going into detail, what are the elements of a ICAP report. So this is the very comprehensive report prepared by a bank. This is for their benefit, not for the regulator, just because of the regulators are required to be submitted. But this is for their own information, for risk governance. This document is prepared. But in terms of Basel requirement, Basel say, okay, you do it and provide to the regulator as well. So I have highlighted about 8 components or the 8 chapters. A general, generally you should look at in ICAP report. The first chapter is about the executive summary of all the rest of the captures, including purpose of the report, scope, the main findings, the material risk, capital outcome, the governance structures, the processes, challenges, and the future plans. So that gives a summary of rest of the chapter analysis. Then if you look at chapter 2, or the section 2 is about the business background, a summarized version. So they are basically the elements it covers the group structure and the governance. Now, especially in the case of a bank which is part of a group, then risk implications. What are the implications of risk? Key business activities. What are the business activities of the bank? The financial summary of financials. The business strategy and the operating plan. So what is the business strategy the bank is focusing on and the operational plan for the business strategy? Key business assumptions. Now, when you build up strategies, financials, especially the forecasting, you need to make certain assumptions, especially for future. So you need to highlight these are the assumptions, so that anybody would look your information or analyze your information based on the assumptions. Because if your assumptions are wrong, then your forecasting also wrong. Assumptions are going to go wrong. Very important from a risk perspective, my assumptions are right or realistic, whether my assumptions are realistic. So those are important. Now, even somebody comes for your bank for a project loan, these are the things you should do. You may be doing. Now, when a project report is given, what do you look at? Complete new project. You don't have any historical data. So the person who borrow will give you a report. So you have to analyze and see what are the assumptions. How is it, rational, these assumptions? Are they going to generate this income? Whether they have capability. So you look from many angles, the business environment, current economic situation, and so on. So similarly, it's very important to look at the business assumptions in terms of risk. Then third area is about current and projected financials, the present financials, the profit or loss and the balance sheet. Then projected for the next few years, maybe 3 years, 4 years, 5 years. So those numbers will tell us about the possible risk. Okay. The expected business trends and operating environments. Very important. What is going to be the business trend, operating environment? So we are part of your judgment. So that's why the judgment will differ from one bank to another bank. Then how do you generate the capital? So you can't take decisions as and when you move on, as and when you take risk. Okay. So you have to take decisions well in advance. Now, for example, if you take capital raising, simply you can't wait an event to take place to raise capital. It's very costly either. So you must have a plan based on your strategic focus. You see, let's say you try to expand your business. Now, let's say your target is to expand your business by 5%, 10% over next 4 to 5 years. So with the expansion, what are the risks you are facing? So probably you may expand to credit, you may expand to the investment. Let's say if you expand to the credit area, then probably you may undergo higher risk. What are the areas? Risk. So then, to overcome such risk, then you must support it with adequate capital. So if you don't have adequate capital, so you must have a capital generation plan. So many things. Then the fourth area is the material risk assessment. So that's again important area. What are the critical risks? So you have to look at the risk framework, governance and the coverage. Is it adequate? Defining population and materiality thresholds. Okay. So even though risks are there, not all risks affecting your business are they material. So you must concentrate on the material risk only. Then determination and mapping of material risk profile. So you have to map the risk in line with the capital. Mitigation of material. What are the risk mitigation you have? Remember, when it comes to risk mitigation, there are 4 methods we have. All depend on materiality and so on. Remember, 4 types we do. So we have to enter the right thing because the resources are limited. Can you give the examples we looked at, the 4 types of risk mitigation at the very early stages of our course? We have a risk matrix, then we have risk mitigation. So how do you, what are the different ways? Typically 4 ways. Can someone tell? As a banker, you can't completely, do the entire risk. Can you give up how do you manage the risk? Different ways. All depends on what you call your risk profile. The 4 ways. No one? At least one way.
Avoid, minimize, mitigate.
Yeah, you can avoid the risk. You completely avoid the risk. You can accept the risk. You can accept, okay, accept the risk. You can avoid the risk. You mitigate the risk, that is minimize the risk, try to minimize, and you can share the risk. So very simple. Manage, that means mitigate, avoid, accept, sharing. Now, how do sharing is basically the classic example of sharing is risk, insurance. So that is what you do in most of the housing loans, because especially you take a insurance coverage also in the case of housing loan for different purposes. But it's risk sharing. So you make some payment and assign or allow the risk to be taken by someone. So all this depend on the materiality. Okay, the systems and controls. So what are the systems you have in place to mitigate the risk, so that you know the level of risk you face? Controls you have. So what are the controls? The capital you have. Depending on the capital, are you safe? Combination of the capital and the risk. So this part, the bank discuss is complete risk assessment, so that we have a broader understanding of what is the quantified capital in terms of Basel, that is regulatory capital, and how much we need in actual. Okay. Now, if you look at a general example, because if you look at 2 banks, okay, both banks need maybe same regulatory capital, they have, but the economic capital they require may be quite different. Let's say bank A has 10% core capital and 12% total capital. The bank B has also 10% core capital and 12% total capital. But if you look at the regulatory capital, both are well above. Both are well above the regulatory capital. That is pillar 1. But the question is, are the risk structures are same in terms of pillar 2? So probably if you do a ICAP, you will realize, okay, bank A probably may be sufficient with 10 and 12. Bank B need at least 11 and 14 or whatever. So that is the economic capital. So that depends on your own bank's risk structure, capital structure, system structure, control structure. Very well known to you. No one else knows about it. Regulators don't know about it. You are the people running the bank. So it is known to you only. So that's why this ICAP is very important. Now, if you look at a general example, if you get into the highway, I mean, like we call capital, now here we know in a minimum, there's a regulatory requirement when you get into the highway, not in capital, but speed limit. So, what is the regulatory requirement?
Variance
Anyone? No one?
and maintain the speed level.
Yeah. So, what is the requirement? Okay. What is the requirement in Sri Lanka? No one has traveled in a highway. Hopefully, none of you. 100 kilometers per hour. That's their maximum regulatory requirement. Now, if you look at a bank, capital adequacy, it's a minimum. Now here maximum. That's again a regulatory requirement. Speed limit in in many parts. There are certain areas maybe 80, but mostly 100 speed limit. So as a person who is driving on the highway, need to ensure your speed limit won't go beyond 100. So that is a regulatory requirement, right? Like the capital adequacy 8 or 10 or whatever minimum. So there you say you must have minimum 8%. That is the pillar 1. But here it says 100. So what does it mean? So when it is a 100, are we all going at 100? If you go above 100, it's a violation. So likewise, capital adequacy go below whatever, 10 or whatever, you are violating the law. So if you go beyond 100, you are violating. But does it mean all of you can go at 100? What factors determine that? Can all of us go at 100, even if it is allowed? Can or cannot? Can all of us go at 100? Can or cannot?
Cannot.
I'm asking a pretty simple question. Can or cannot? Can all of us on the road, highway, can all of us, because we have been allowed to go up to 100, max 100. Legally, we have given authority. So does it mean can all of us go at 100 or not?
No,
No. Why?
because it depends on the speed limit. Sorry, it depends on the how there's normally how we drive. Somebody may go around 70 kilometers. Somebody may 90. Somebody may around max.
Okay. Why is that? Why is that? I am asking that question. Okay. It's not 100, maybe 70, 80, whatever. What determines that?
Personal choice.
No, yeah, choice is there, but what determines rather than choice, it's not automatic, no. But there are certain other things, even if you, now let's say your choice is 100. Your choice is 100. Can you do that? Your choice is 100. Let's think about choice 100. Can you still do that? Okay, your choice is 100. Can you do that? Legally allowed. Can you still do that?
Depend on the experience and the capacity works on it.
Experience, what the capacity? Tell me a little bit elaborate.
It's the vehicle capacity, how the vehicle performance.
Exactly. Yeah. So it all depends on many internal and external factors. I'll start with external factor. Heavy rainy day. Heavy rainy day. My choice is 100. Can I go at 100? Heavy rainy day. Significant wind blowing. Can I go at 100?
No,
My choice, huh?
no, we can't. It's little
Because
slippery.
the external environment is such a way, I will face a significant risk if I go at 100. I am allowed. I am allowed. Let's say still 100 is allowed. I am allowed, but I can't go. Because I have to decide, okay, now I can't go at 100 despite legally allowed. Because that's the external risk I am facing now. That's the external risk. Despite I have a supercar. Then internally, that all depends on your type of car, your type of, what do you call, let's say, you are running in a big Mercedes-Benz or BMW with a new car, or you have all these sophisticated brake systems, everything. Then, you have sufficient capacity to meet any unexpected risk. So that you can still go. But let's say your tires are, pretty old, almost flat tires. Your car is 25 years old. Can you go at 100? Can you go at 100? Come on, I mean, give quick, answers. Can you go at 100? You are 25 years old car. The tires are also not, huh? Can you can't. You can't, because your internal capital is pretty low. It's like your capital, your strength is pretty low. So then you can't take that risk. Because suddenly, usually it won't happen. Usually it won't happen. Suddenly, two-leg bull cross the road. Two-leg bull in the highway. Chances are very low, very minimum, but we never knows. Because his house is on this side, brother's house on the other side, suddenly cross it. We don't know. So two-leg bull cross. Normally legs have, bulls have 4 legs, here two-leg bull. So what happened? Unexpected risk you have to face. So the one with, all this new technology, everything, tires are good. Even if it goes at 100, you can meet the risk. You can manage some to some level. If it's a pretty old vehicle, even tires are not good, brakes is not good. So that is economic capital. So even though here you are allowed to go at 100 max, you can't. So who need to decide about it? What is ideal for you? Who should decide it? Who knows about that? Is it the regulator or you? Is it the police or you? Who should? Who has fixed the limit? Maybe police. Then who should decide the right level? Is it the police or you?
We should decide.
You should decide because you are the known. I don't know. If I take your vehicle, I don't know. None of about. None of them. You are the owner of the vehicle. You should know. You are driving me. You know everything in and out of the vehicle. So you should decide, okay, I have been permitted at 100, but I can't go because of these things. So I will go at 60. So that is the concept of economic capital. Okay, your regulator say 10%. As far as you meet 10%, fine. You meet regulator capital. But once you do your internal risk assessment, you are the one who knows exactly about of your entire risk level. It's not just the minimum regulatory requirement. So you can do it, user, through ICAP report. So once you do it, you have to aggregate risk and capital. The market risk, material risk included. So you have to include all material risks. What are the important risks? Okay. Capital assumptions per material risk and in aggregate. So for each risk, how much you need capital, top of the regulatory capital, and in total, and about just diversification if needs. So many things, I mean, just few things highlighted. Then capital management program approach. So once you identify the risk, once you feel that you are not comfortable with running at 100 speed, okay, compute it and plan Okay, next time, plan it for a better. So replace your tires, ensure your brakes are in order, and your engine is on order, which is not heating. Then you can still go at 100, and if there is any risk, you can meet that. So there, the capital. So once you identify, ensure you have a comprehensive futuristic capital plan. So the capital cannot be, pumped as and when you want. That all depends on market conditions that will prevail at a future date. We never knows. We never knows. Then seventh area is sensitivities and future scenarios. So at least look at future in a different ways. Maybe at least for 3 years, if it is difficult to forecast for 5 years. Okay. Assumptions, key assumptions underpinning the base case. Do stress testing and scenarios. Okay, so do the historical, look at the scenarios and forecast. So this is basically about, once you model it, do stress testing and see what could be the impact on your balance sheet, what could be the impact on your dividends, what could be the impact on your capital, and how much capital you require to be pumped in. Then the final part is the ICAP governance. So once you identify all the materials, identify the capital required, and when you have a capital plan, build up a governance framework. It is very important. Build up a governance framework. We call ICAP governance. So which include integration of risk, capital management, business, strategic plan, many things. And also how you are going to allocate capital. Okay. And how your management information system will support in by way of reporting, and how frequently you should analyze and take decisions. So basically, under pillar 2, principle 1, the ICAP gives you a fairly comfortable detailed analysis of your economic capital requirement, which is top of your regulatory capital requirement. Okay. So as I mentioned, there are a number of risks you could cover in ICAP, other than the general market operational risk. The credit risk, where concentrations, market risk in the banking book, operational risk, which you feel not covered, the interest rate risk in the banking book, even the liquidity risk. Okay, even though now we have separate, ratios for liquidity risk, LCR and NSFR, but you can factor the model risk, the models you have, built themselves may create some risk. Then the business, strategic, reputation. So it's when you look at a ICAP, you will capture all those risks in determining what is the right level of capital. It's purely exercised by the bank, where regulators don't have any control. The regulators don't have that information. What they can do is, when they see a report, they can see whether your judgments are right, whether you have made a fairly reasonable assessment to come up with the numbers. So ICAP should explain the process by way of policies, procedures, systems, controls, personnel for identifying, measuring, managing risk on a continuous process. So that is part of the governance as well. So what other factors should management consider in determining target capital levels? Regulatory ratios and requirements. Okay. Anyway, your economic capital requirement should be above the regulatory capital requirement. Peer comparisons. How others are faring. Somewhat similar to you. Somewhat similar risk faced by you. How others are faring. So it gives a judgment. Am I adequately, compensated or covered with capital for risk? So am I behind, or am I too risky compared to what peers doing? You see, the expectations of shareholders, counterparties, and rating agencies while you are, maintaining your risk capital at a comfortable level, shareholders are also expecting a fairly comfortable dividend. Okay, so they may worry about their dividends if you don't have adequate capital, so that you are required to retain the capital, the earnings or the profits. Then how the counterparties look at, how the rating agencies look at. So rating agencies, when they give a particular rating, they expect, okay, if you want to get this sort of a rating, you need to have maintained this much of capital. So you have to look at those. Concentration, credit, and other risks, which we discussed, the business cycle effects. This is the most important thing. So what will happen to the business cycle? What will happen to the bank in the business cycle as a result of business cycle effects? You know, the booms are there, the risk, appreciations are there, you know, these will change over time. The stress test, forward-looking stress test. So when you do the stress, which we discussed earlier, what areas you feel we are really subject to high risk. Then formal modeling and risk analysis. So you can do the modeling. I mean, these are two are parallel, stress test modeling, and look at the risk. Other quantitative and subjective factors. So there are, qualitative and subjective factors. There are many other factors which you will feel would end up with particular risks. So that once you factor those into account, you can determine the right capital level. Okay, stress testing. Now, banks should include stress test as part of their ICAPs. Sorry. So what is a stress test? Can anyone give an example of a stress test? How many of you have done any stress test in your analysis? In your office work? Anyone engaged in stress testing? No one? Okay. Anyone heard about the stress test? How do you do it? No? Okay. Now, stress testing is a very popular tool in risk management. So where you think of future stress scenarios, you assume certain stress scenarios. I will take a very simple example related to credit risk. Okay, you know your level of credit risk now. Let's say your bank's current gross NPL or net NPL is about, let's say, 5%. Okay, 5%. Then you assume based on future possible scenarios, okay, my NPL will go up to 10%. If my NPL go up to 10%, what would be hit on my capital? So it's a hypothetical scenario of a future event, whatever future event. If that happens, what would be my benchmark indicators, negative impact on my benchmarking? What would be the final hit on my capital? So you can assume some scenarios. Maybe my NPL increased by 20%, my NPL increased by 50%, and so on. Now, recently we did some scenarios for our, let's say, finance companies, the possible hit on the moratorium loans. If the moratorium loans, whatever the moratorium loans granted become NPL by certain percentage, what is the impact on capital? So we did some stress testing from our side. When we want to look at the stability of the finance companies, right? So whenever our guys look at, the particular portfolio subject to moratorium, let's say at the end of the moratorium, now moratoriums will be over soon. What would be the impact if 20% is not paid, if 50% is not paid, if 100% is not paid? And they do the stress testing and they analyze the numbers and they say, okay, if 100% not paid, this is the capital adequacy ratio. This will drop to this level. If 50% not paid, this is dropped to this level. So these are hypothetical scenarios, but will give us a comfort about overall capital adequacy level of entire system. So it's something like that. Do a stress scenario, look at a stress scenario and look at your fundamental impact on capital adequacies. Okay. Then relate to potential risk and changing capital resources. The results of stress test can be used to change the risk appetite. So when you see you are subject to significant risk, now you have to challenge your risk appetites. I just took extreme example of moratorium, but even in general case, let's say there is no moratorium, but then you have to see, okay, you can further elaborate, okay, what areas I would be subject to risk, depending on future possibilities, probabilities. Then adjust the strategy. Adjust the strategy. Probably you may need to rethink about your strategy to a high risk strategy to a lower risk strategy. Set limits. So you can set limits, the controls, so that you minimize future risk. Adjust the controls, which I already explained. So if you feel that you have loose controls, maybe you can little, make them stringent, make them little stringent. Develop capital management and funding plans and targets. Okay. While doing so, if you feel you will be subject to significant risk, if this happened, now itself develop capital management and funding plans, some targets. So it will help you to identify potential, risks that you will face in the future based on some, assumptions, and then how it's going to impact your capital levels. Now, in our day-to-day life also, we do some stress testing. Some of you have already done, some may not have done, maybe your relatives have done. What is the classic stress test we do in our day-to-day life? For our health purpose. A classic test, I think maybe young generation may not have done, but it's good to do. It's good to do. Even though you don't have any particular symptom or anything, it's good to do. Very much classic stress testing is an exercise ECG. What does exercise ECG does? It's a typical stress test on your heart functioning. No need to wait till you get a chest pain. You go to a hospital, you ask, I want to do a stress testing on my heart, which we call exercise ECG. So what does the exercise ECG does? It's a simple stress scenario. So you are asked to get onto a treadmill, okay, treadmill, and they subject your heart into different stress levels. Okay, probably they may start with 3 kilometers per hour speed limit. Then you have to walk on the treadmill like you do exercise. And then they measure the heart rate. They measure the heart pressure. Then what they do? They increase the speed. So they measure at 4 kilometers per hour how your heart works. What is your heartbeat level? What is your pressure? Then they increase the speed. Okay, they say, okay, now we are going to increase the pressure. Speed, 6 kilometers. Now, when you go at 6, probably your heart rate will go up, pressure will go up. So they look at that, how your heart works under a different stress scenario, 6. Then further they say, okay, now I am going to increase to 8 kilometers per hour. You are subject to another stress level. Then your heartbeat will be much different. And sometimes they stop because your heartbeat is come to a max level of tolerable level. Otherwise, you will subject to heart attack. Then similarly, there are another ways that they do increase the stress. How they do it? They start with a flat level of walking. But then they say flat level means zero angle. Then they say, okay, now I will little bit angle the belt, treadmill belt. What they do then? They want to measure your stress when you climb up in a little bit steepy. I mean, you are very good when you walk on the flat road, but now they give a little bit steep, 5 degrees, 10 degrees, 15 degrees, like a big steep hill you are climbing. So they measure how your heart works when you move on a flat road at different speeds, how your heart works when you want to climb up a hill. Now, some people can't climb a hill. At least this different pressure go up much faster than a flat road. So that's a typical stress test. So they look at different stress levels, flat speed levels, angle speed levels, and see you will get the results. And they will come and say, okay, these are the risks you face. These are the risks you face. Sometimes they detect a significant problem as well. Hey, your heart, better you get easy, what you call angiographic done and do a heart, your valves are pretty big. Okay. So there are so many conclusions you can make from this. So that's a typical stress test we do in our normal life. So banks same. So you assume stress scenarios for different factors, credit, market, liquidity, many factors. You can combine the factors, run a simulation, analyze it, and identify the risk. I think all of your banks, I think your risk management students must go speak with your risk management colleagues and look at these things. I mean, by book you can't learn. I'm telling a story, you listen, that will not help. Go to your colleagues, ask how it is happening. Now we do macro forecasting, macro modeling. We do for capital, we do for liquidity for the entire banking system. We have a macro prudential department. So they recently developed a big model for capital for the entire banking system, financial system, basically banks. So that's a macro analysis. So we give a different stress and see how our banking system would last. But it's macro level, not individual level. But you as a bank, you can do it individual level and identify and ensure you have sufficient capital. If not, need to come up with a capital plan. Okay, so that's capital planning. So what is capital planning? The bank's strategic roadmap for bringing value while anticipating and adapting it to change. Now, as you know, once we identify certain things risks we can avoid, but certain things we can't. So only way is we should have sufficient capital buffers in place. Okay. So the capital planning is the strategic roadmap for bringing value while anticipating and adapting to change. So it's a strategic roadmap for bringing value while anticipating and adapting. Because we are living in a world of stress. No one can change it. Nothing will materialize as the way we want. We live with a risky world. Everywhere, even if you look at not even a bank, many risks. Now, the latest about the Russian-Ukraine war, what is the latest news you have? Even some of them may gradually affect the banking systems as well over long run from an indirect way, not direct. So what is the latest significant risk news as a result of war? Anyone take? Any particular risk? Significant risk? No one? Russia has shut down the gas line for Europe. So the Europe major gas supplier is Russia. And there's a gas line from Russia to Europe. Mainly ties in Germany's all major activities from that gas. So what happened now, they have initially, reduced the level, but now what I heard is they have shut. So if they are going to shut, what happened? Entire Europe will not be able to get the gas. They have to go for alternative markets, Middle East or other markets. What happened? So now demand supply works. You see, the price will go up. Okay? Price will go up and may not be sufficient. So how? Probably the industries will be affected. That means in turns, they will not be able to pay your loans. I mean, not here in Sri Lanka, but those countries. If this is going to continue, okay, if it is temporary, it's okay, fine, good. So these are the risks, you know. So how indirect risk will affect your bank? This is a totally indirect to your banking model, even here in Sri Lanka. So if the gas goes short, then what happens? Even even if you have some foreign currency, you can't bring in gas. You see, so that's why very important to look at different risk models and ensure to cover up even unexpected, uncertain risks. You have a buffer. So if you have a buffer, because you cannot predict each and everything, each and everything for the future. So there's a great uncertainty. So you can still still maintain adequate capital. So should outline target capital levels given the bank risk profile, risk appetite, regulatory capital requirement. You decide, okay, this is my capital level. I need to move on with. It is costly, but can't help. Can't help. Strategy for ensuring adequate capital is maintained over time. So you must have a strategy. Even there are risks, you can absorb and maintain at a particular level. So you don't want it to come below that level. Let's say your target level is, okay, regulator say 10%. I am targeting 12% always. So let's say my level is 14% now. So my target is anyway, I don't want allow it to come below 12%. So you must have a strategy, some benchmark level. So to do that, you must have capital buffers and triggers and action to avoid any breaches. Suddenly, when you see your capital is falling, you must take appropriate action. The capital management process, that is the management of capital, external capital and funding source. Always have a good liaison with what you call funding sources, external. But you can't get capital in a hurry. When you are short of capital, urgent basis, you can't get the capital. So, and the expected cash. So, the capital planning broadly a complete task of pillar 2 as a process of risk management. Okay, so we'll finish this slide and take a little break. The process for regular reporting to the board and senior management. So it's very again important. Now, all these activities are part of your operational management as well. Okay. But you must bring them now to the board and senior management so that they are the policy makers or they are the people who make policy decisions of your bank. So you must report on a regular basis the risk exposures, the regulatory capital requirement, the capital levels to the targets requirement, earnings forecast, the other forward-looking consideration, threats, challenges, and uncertainties. So once the senior management and the board sees this, it is their duty to react and take appropriate actions, especially the threats, challenges, and uncertainties, right? Importance of monitoring, reporting, and review of risk and capital, including ongoing compliance with regulatory capital requirements and capital targets. Very important. Ongoing monitoring, reporting, and review of risk and capital, including ongoing compliance with regulatory requirements and targets. Ongoing review of ICAP, example every 3 years. I mean, once you build up an ICAP, the same risk, same future will not prevail over time. So let's say you forecast and you believe certain risk today for the next 3 years, but after 1 year, you know what happened, what went wrong, what were the things you could not predict, what were the things you predicted did not happen. So you can revisit. So at least every 3 years. Okay. Because if you look at the world today, it's very difficult to forecast over a long horizon. So most countries, the most, financial sector institute now focus on a very short strategy, short horizon, like 2 to 3 years. So 3 year forecasting, at least 3 years, because you can't change the strategies every year also. But look at a reasonably, comfortable future, 3 years or so. Okay, any questions? Anything you need to clarify? No? Okay. So it's almost 10:50. We will meet again 20 minutes time, like 11:10. So we'll stop for a little break, tea break, and we'll start around 11:10. Okay, thank you. Okay, banks are required to maintain, do assessment of their own capital and should ensure they have sufficient economic capital to meet any expected and unexpected risk. So the pillar 2 is about supervisory review process. Uh, Supervisory review process. That is principle 2. Supervisors should review and evaluate banks' internal capital adequacy assessments and strategies, as well as banks' ability to monitor and ensure their compliance with regulatory capital ratios. So basically, once a bank does a ICAP, the responsibility also there with the supervisors to look at what the bank has done is right or adequate. So that is the objective of pillar 2. So the regulators use many tools such as on-site examinations, off-site surveillance, the off-site periodic reporting, review of work done by internal and external auditors, meetings with bank management, review of bank information, etc., to determine whether the ICAP reported was reasonable, accurate, and whether it clearly described the relevant risk to support the capital levels. Then there are many areas where the supervisors will review: the board and senior management oversight, the systematic capital assessment and planning, comprehensive risk assessment, stress test, monitoring and reporting. Okay. So these are broad areas the regulators will look at. What is the oversight and the board and senior management oversight, how the bank assess capital and plan capital, the risk assessment, whether the risk assessment is comprehensive, and the stress test, and what is the monitoring and reporting requirement in progress. So these are typical areas a supervisor would look at. Okay. So let's move on to the third principle, the capital above regulatory minimum ratios. So once a bank does ICAP, the regulators expect banks to operate above the minimum regulatory capital ratios and should have ability to require the banks to hold capital in excess of the minimum. So basically, regulators requires banks to ensure they cannot run with the regulatory minimum capital. because that is only the capital required for, requirements for the risk under Pillar 1. So banks' risks are beyond Pillar 1. So that's why you need to ensure you have sufficient buffer against any potential risk. They should urge banks to maintain above minimum based on the ICAP. So why should a bank operate with an additional capital buffer? Competitive reasons. Now, all of you know there are a number of banks in any country, any financial system. So they compete among each other. In competition, they face many risks. They take risks due to the competition. So in doing so, they will subject to more risk than under less competitive environment. So they need some sufficient buffer against, any risk. Fluctuation in the overall capital ratio occurring in the normal course of business. Every time a bank engage in a particular business, the capital adequacy ratio goes up and down. You see? So you need to have buffer because you can't bring in capital or change your risk profile every moment of time when you do a business. Okay. So let's say classic example is let's say your minimum capital total capital requirement is 10%. Okay, 10%. Then your capital is 10.1%. Okay, so minimum requirement is 10%. You have 10.1%. Assume. So are you complying with the minimum capital requirement under Pillar 1? Are you complying?
Yes.
Yes, because under Pillar 1, bank is required to maintain 10, but you have 10.1. Now, let's say there's a customer who want to obtain, let's say, 100 million loan. Okay, but he is not willing to provide any, let's say, collateral or anything, but is a good customer. So in terms of your, risk categories, you have to maintain what you call 100% capital. Okay, 100% capital, because for whatever reason. So then, if you were to grant this loan, your capital will come below 10%. So that may be 9.5. So what happens? If you grant the loan, it's maybe a good loan, but as a result of the loan, your capital will come down to 9.607, 0.4% drop from 10.1. Then what can you do? What options you have? Or do you have any option? What options you have? Or do you have any options? Can someone tell?
If he is not giving security, then we can ask about loan protection policy or something.
Okay, forget about it. He doesn't have any loan collateral.
Okay.
So he is not in a position to give any collateral. He simply asks a loan, but appears to be a good customer, 100 million. But as if the loan to be granted, capital fall to 9.7 from 10.1. So what is the situation bank face? That is the situation. Simply, I don't think bank can give the loan because the bank's capital drop means regulatory violation. So the bank lose the opportunity. Because bank can't bring in capital no immediately when a customer come today and ask. So you bank miss a good opportunity, business opportunity, because as a result of very marginal capital level it operated. Of course, if the bank had 11%, easily bank would have given this loan because he has a buffer. So that's why it is very important you have sufficient buffer because you do the business day-to-day basis. You can't change your risk profile or the capital, bring in capital whenever a particular transaction take place. So the fluctuation in the ratio, even though you don't see it regularly, may be significant. Again, cost for a bank to raise capital, especially when needed quickly or when market conditions are unfavorable. Especially, let's say, suddenly you find, due to whatever reason, your capital comes below the tolerable level, then of course you need to raise the capital. But when you want to raise capital urgently, the market knows about it, and also difficult and costly, and also maybe not the right time. At the time you want to raise the capital, the market conditions are pretty weak. See, so it's not easy. So the bank-specific risk or macroeconomic factors may not be taken into pillar one. Now, there may be some macroeconomic factors, which may not be covered in the pillar one. And also now situations like, COVID and all, suddenly unexpected, we never knows when would be the next hit will come, you see. So we never knows. Even now, say, today the even the Putin has warned all Western powers that if they sanction any flights movement, Russian flights movement over Ukraine, they will hammer all over. The significant threat. A few minutes ago, he has, indicated because the Western powers want to ban, Russian planes over Ukraine. If that is going to happen, they will hammer all around Europe. So that's a threat. We don't know whether it happened or not, but that's a classic threat. There will be so much risk coming of that if that happens. You see, even take airline now, they all have to divert. If you look at the flight map yesterday, Europe flight map is full of flights. You see, which used to be somewhat diverted. Used to be travel over the Russian airspace also. Now all are diverted towards Europe. So that again maybe maybe if it is a long route, the cost of fuel consumption may be high. So there may be a lot of repercussions. So any uncertain event in the macroeconomy can have an impact on your capital, which you don't have any knowledge of it. You don't have any knowledge of it. So even COVID, no one forecasted COVID. So see the impact on the banking sector. Still people asking for some more extensions of moratorium. The people can't pay. So how do we know when will be the next virus coming? Maybe 2 years later, 3 years later. We never know. Maybe probably this may lead to a third world war, which all of us are in deep, deep trouble. Maybe economic collapses, financial system collapses. Okay, even affecting the normal living of we never knows. We hope that will not happen, but we can't predict. So as a banker, you must factor all such risks and should have sufficient buffer so that even if such event happens, you are comfortable with your regulatory capital. The final principle under Pillar 2, that is supervisory intervention. The supervisor should seek to intervene at an early stage to prevent capital from falling below the minimum levels required to support the risk characteristics of a particular bank and should require rapid remedial action if capital is not maintained or restored. So again, if you look at these 4 principles, there are 2 things directly the responsibility of the bank, that is principle 1 and principle 3. The principle 2 and principle 4, that's the responsibility of the regulators or the supervisors, the central banks, to intervene at an early stage to prevent capital from. So even the supervisors, the central bank should not wait until the capital levels of a bank fall below minimum level. Well, even their responsibility to ensure, while the bank's responsibility with the buffers to maintain sufficient buffer, but their responsibility as well to ensure whenever they see the bank's capital coming below that, take remedial action. If the bank fails to bring in the new capital or maintain or restore the capital at the right level. So the supervisor should increase the monitoring of those banks continuously, and also tell the banks to improve the ICAP process so that they can identify risk much faster, better, and bring in more capital quickly. Then the regulators can require the banks to submit a capital restoration plan. Okay, whenever they see capital is significantly coming down, also regulators can restrict certain business activities, especially which involve capital, mergers, acquisition, expansions, and so on, which really don't warrant urgently, to avoid any further capital depletion. If you look at acquisitions, new purchase of new ventures and so on will result in significant capital going out. So the regulators can restrict that. Also restricting dividend payments. Okay, so whenever they see they are going below the buffers, minimum trigger levels, then they should even restrict the dividends, because that will again outflow. Rather than that, bank can retain the earnings without paying dividend. And also to the extent if the regulators feel the either senior management of the boards are pretty weak or don't have capacity, even requiring
Sir,
the
excuse me, sir.
yeah.
We are in the
Sorry,
slide 36. We are in the slide 36.
I can't see the number. What is the slide?
Process
Potential.
of supervisory review.
Sorry.
Slide 36. Process of supervisory review.
Is
Slide
that
is not moving, sir. It's not moving.
is it moving now?
No, sir.
Now it's okay?
No, sir.
Huh?
No, sir.
Not yet. Is it moving?
No.
No. Moving?
No, sir.
Moving?
No, sir.
Not yet. Can you see it or?
Now, sir, stop sharing.
Can you see?
Yes, sir. For slide 42.
Huh?
Yes, correct, sir.
But you can't see the full version. Right? 10? Is it moving or not moving?
Moving, sir.
Okay. So this is the slide we were discussing. Is it all right now?
Yes, correct.
Okay. So these are the potential supervisory activities, actions which the regulators can take. That was the topic we were discussing. So even to the extent of replacing the senior management and or directors of the board, which regulators feels comfortable, right? Okay. Any questions so far? Anything on pillar 2, Basel 2? We'll come to pillar 3 towards the latter part of the lecture. Okay. So let's move on to the Basel 3. I think Basel 3 we have discussed very briefly when we discussed the liquidity risk, because the Basel 3, there are two components of Basel 3. One is the capital part and the other one is the liquidity part. Of course, liquidity part we discuss when we do the liquidity risk. That is the two ratios. That is what you call liquidity coverage ratio (LCR) and net stable funding ratio (NSFR), which we discussed in detail a few weeks ago when I did the liquidity risk. But here today we try to look at the new reforms relevant to the capital part and the other risks. Okay. So, as you know, the global, not recent, now it's almost 10, 15 years ago, the financial crisis that resulted in a multitude of, we call the GFC, global financial crisis, resulted in a multitude of proposals from stakeholders at global, regional, and national levels for a fundamental restructuring of the approach to risk and regulation. So now you see, due to many failures in 70s, early 80s, the Basel was, Basel came into effect in 1988, to have some sort of capital, standardized capital for credit risk. But then in 1996, it was expanded to cover operational risk. Then 2004, Basel II came into effect. That is with modernized version, that means pillar 1, pillar 2, pillar 3, pillar 1 expanding it to operational risk as well, and we just now discussed what is pillar 2. But while Basel II was in progress, we had to face the global financial crisis in around 2007, 8, 9 period. So as a result, again, the regulators and the stakeholders at all levels, national, regional, and international levels, thought that we should further strengthen capital adequacy framework. The minimum regulatory capital levels of the banks were insufficient to mitigate the risk from the exposures and actual losses of the banks suffered during the financial. Even very big banks were subject to significant risk during the GFC 2007 to 9. Okay, so that's why even like like international banks like Citibank had some shocks, as a result of these unexpected risk events. So the few questions which came or which discussed the quality of regulatory capital appeared offered insufficient to absorb bank losses effectively. So despite there were improvement in the levels of capital and the risk based on risk, but there was general feeling after the crisis. Sorry?
Slide is not moving, sir.
Is this there?
No, sir.
43 not there.
Oh, 43 and 44 not moving, sir.
Did
Still
you
we
see the
are,
43?
oh, better.
44?
No, sir.
You can see the 42,
Yeah, sir. We are in the 42 on.
42, 43,
No, sir.
not 43,
Not 43. Not
44,
available.
no. Huh?
No, not available, sir.
Is it moving now?
No, sir.
Let me go back again. Is it moving now?
Yes, sir. Now 44. Yes.
Okay.
Okay, sir.
Okay. Can you, is it moving now?
No, sir. Not moving.
From this end it moves, no?
Yes, sir. Yes.
Problem. Moving. Can you all see
Yes.
this? Can you all see this small version?
Yes, sir, now it's okay. Left side we can see, and it comes to the screen. So it's not
Now,
in the presentation mode. Yeah, can see.
is it moving now?
Yes.
Move.
Move means when you put the cursor onto the left side, so we can see it on the right side in the as a main slide. So it went from 46 to 44.
Yeah, but now can you see the full one now? Basel 3 reforms.
Basel III. No, now you are in 44.
Are you in 44? I don't know why it's not moving. Now? No.
No, nothing.
It's still 44.
Yes.
Something wrong with this when you put up the big one. You can see this, no?
Yes, sir. We can see the slide 44.
But can you see it properly? Because that's a
Yes. 44
small
have.
version.
Yeah.
If you can see this, I am fine.
So check whether you can, I can see, check whether you can use the right hand bottom plus sign and make it increase.
Huh?
Right hand at the bottom, you can make it like use the plus
Expand the
sign.
size.
Yes, plus, click the plus.
Yeah, I want to see. Yes, also not moving properly. But everybody can see, we can continue. Size, I can't change it here.
I can
Okay.
see, hope others can see.
What about others who are in? If you can read it, please tell. Otherwise, we have to adjust the size. Size, I can't move the cursor properly. That's the reason. Can all see it now? Can see?
Yes, sir. I can see it's moving also.
I don't know why it's not moving when it also.
It's moving, sir.
Huh?
It was moving. It's not on the presentation mode, but it was moving when you were like.
Yeah, but can you see its presentation move now moving?
Yes, sir.
Huh?
Yes.
Now I am going to the next slide. Is it moving?
Mm, no, no, still in 44.
I get that. Maybe presentation mode something wrong. Okay, let me switch off to the other mode. What to do? Okay. If, can everybody see this?
Now in 43.
43, no? Yeah. Can you all see the slide number 44?
I can see.
What about others? We'll give a last try to this one. Not moving, no? Is it moving or no?
44 on the left side is highlighted, and we can see the 44 slide on the right hand side.
45 you can see?
45, the small version we can see, but it's not appearing in the right hand side.
Not the presentation mode.
No. Maybe,
Okay.
sir, if you can go down from the drop arrow key for the left side, just check whether it's coming onto this.
Yeah, okay, I'll try that one. Okay, so we'll uh, 44, no? You mean it's moving to the left side?
Sir, I was telling not going to the presentation mode, the same mode that you were using, but on the left hand side, the small slides you can move from the drop down
Ah, yeah, I
menu.
can do that, yeah. Okay. Otherwise I'll. You can see 44 in the full screen now, no?
Still, it's not appear in the presentation.
Okay.
Nothing is there in the screen for me.
You can see 44, no?
Yes.
All version?
See, and it was coming down from the top when you were
Okay.
scrolling.
Okay. So if you all can see, so basically the idea was that quality of regulatory capital appeared often insufficient to absorb bank losses effectively, and also inadequate capital to capture risk arising from bank exposures to transactions such as securitizations, derivatives, and repurchase agreements, or take into account the systemic risk associated with increase of leverage in the financial system. Also did not have internationally accepted quantitative standards for liquidity. We have discussed that one. I'm not going to discuss it again. But broadly, if you look at the quality, it's the question of quality of capital. Despite the Basel II came up with 3 pillars and different capital structures, but even that was not sufficient during the global financial crisis. So that's why regulators thought that it was better to have a, further improvement in the capital structure, right? Can you see the next slide?
I can see.
What about others?
Okay, sir.
Okay, little bit small version, but if you can see, that's fine. So if you look at objectives of Basel III, that to strengthen global capital and liquidity regulations with the goal of promoting a more resilient banking sector. Okay, so to ensure to strengthen the global capital and liquidity regulations. So liquidity part we already discussed, but we will see what are the capital improvement the Basel III suggested. To improve the banking sector's ability to absorb shocks arising from financial and economic stress, which in turn would reduce the risk of spillover from the financial sector to real economy. As we observed during the GFC, global financial crisis, it did not, whatever the crisis came from the financial sector, it did not stop there. It spread to the real economy. So that was the question many regulators asked, many central banks thought of. So that it is very important to curtail stress without moving into the real economy, because if any crisis in a financial sector moves to the real economy, then it will have a very devastating impact, right? So in the Basel III reforms, you can see, no?
Yes, sir.
Okay.
So we can.
Okay, thank you. So what are the capital reforms? Basically, the Basel III looked at the quality, consistency, and transparency of capital base. So the importance was given to the quality of the capital, consistency. Capital should be consistent, and also the capital structure should be transparent. Because sometimes some capital elements, some banks, identify or incorporate may not be transparent or equally not, acceptable all over, internationally. So it's very important to ensure there's a standard, transparency of all capital structures, capturing all risks, and also controlling leverage. Now, if you look at leverage is about debt to equity. Now, when somebody comes to obtain a loan from your bank, basically you look at the leverage, how much debt to equity ratio. But if you look at the banks debt to equity ratios are very high, because banks are running from depositors' money with less capital. So if you look at a bank's leverage is significantly high. So Basel introduced a factor or ratio for leverage as well. And also, Basel III came up with 2 capital buffers, which we'll discuss shortly. Capital conservation buffer and counter-cyclical capital buffer. Okay, so we will discuss them little later. Okay, so let's move on to what are the new requirements under the Basel III. Now, basically, I will discuss the general elements what the Basel III came up, but then later I will go through the Sri Lankan, conditions applicable in the Sri Lankan context. So, minimum capital requirements and buffers. The capital, now remember, under the Basel 1 and 2, there were only two components of capital, the tier 1 capital and the tier 2 capital, and then the total capital. Now, tier 1 capital is called the core capital, and the tier 2 capital is called the supplementary capital. But then, when considering the quality of the capital, the Basel III suggested the tier 1 capital be further divided into two components, that is common equity tier 1 capital and additional tier 1 capital. So it's a further improvement of quality side. So tier 1 capital is anyway improved capital, quality capital, but the Basel III suggested, okay, to ensure the further strengthening, let tier 1 be subdivided into two, common equity tier 1 and the additional tier 1, right? Then the tier 2 remain as it is. So then, what are the new ratios it suggested? Now, earlier, under the Basel 1 and 2, what were the, I am referring to the international standard, not Sri Lankan. Don't get confused with the Sri Lankan requirement. I will come to that later. So internationally, what were the original requirement of Basel 1, Basel 2? Core capital, how much ratio? What is the international requirement for the core capital? Can someone tell?
4%? 4%?
4%, total
8%?
8%. So those were the international requirement for the core and total capital under the Basel 1 and 2. Now in the Basel 3, now I said core capital divided into two components, that is common equity tier 1 and additional tier 1. So what the Basel 3 did was the core capital or tier 1 capital was raised from 4 to 6%, right? 4 to 6%, of which now the tier 1 capital further divided into two, no? What is called common equity. So the common equity tier 1 capital must be at least 4.5%. You see? So if you look at the structure and the total capital to be maintained at 8%, okay, of risk-weighted asset. So when you look at the structure, what has happened? Now, out of these two, tier 1 and tier 2 capital and the total capital, in a total capital, earlier out of 8%, 4% need to be in tier 1, minimum 4%. But here out of 8%, tier 1 minimum is 6%. What has happened then? The tier 1 capital is the most quality capital, no? So the tier 1 capital requirement has gone up. So the bank's ability to maintain tier 2 has come down. So it's a further improvement. But then the second one is on tier 1 also, 4.5% need to be in common equity tier 1, which is much stronger quality capital. So all these measures, so because the total capital has remained same, but within the total capital, the Basel III has improved the quality level of, stronger capital. So basically it has improved the quality aspect. So earlier 4 and 8, now it is 3 components, that is common equity tier 1 4.5%, tier 1 6%, and the total 8%. Can see 49 slide?
Yes.
Okay. So if you look at,
Yes, sir.
okay. So if you look at the simple bar chart, the original version I am referring. So if you look at common equity tier 1, you see, so that's a new element. So 4.5%. Okay. Then tier 1 earlier 4 to 6% now. Okay. Then tier 2 is basically 8%, right? 8%. I will come back to this chart a little later because once I finish the rest of it, only you can understand properly. So I will come to that. Okay. Now, also Basel defined what are the items of a bank, capital elements of a bank that could take into common equity tier 1, that could take into additional tier 1, that could take into tier 2. So they redefine the different components of capital which are eligible for common equity tier 1, additional tier 1, and the tier 2. So if you look at common equity tier 1, I'm not going to discuss in very detail because if you read the relevant directions, you can understand very much stronger capital, which require like common shares issued by the bank that meet the criteria for classification as common shares for regulatory purposes. So then stocks, pluses, retained earnings. So there are so many items which the Basel defines as the common equity tier 1 capital. Then additional tier 1 also capital, they have given, different elements which are eligible. I have, given the brief description. Don't worry too much about it, but you can read through. Then tier 2 capital. So all these definitions are given. What elements you can consider as common equity tier 1, additional tier 1, and the tier 2 capital, right? Then most important thing you have to remember is, I think under Basel 1 and 2, most of the, adjustments, need to be made from the ones who at the tier 1 and tier 2 before the total capital adequacy, total capital computation. Let's say you have a tier 1 of 50 million, tier 2 of 30 million. So your tier 1 and tier 2, let's say 80. And your total, if there are no adjustment, your total capital would be 80. Tier 1, 50, tier 2, 30, total capital is 80 if there are no adjustments. Let's say there was some adjustment to be made of 10. So tier 1, 50, tier 2, 30. So adjustment is 10 to be deducted. So the total would be 80 minus 10, 70. So that adjustment has come after the addition of tier 1 and tier 2 earlier. But newer codes say you need to, there are certain adjustments from the tier 2 as well, but many adjustments which were earlier to be made under tier 1 plus tier 2, now to be made under the common equity tier 1. So those adjustments are to be made from the common equity tier 1. So what does it make? So earlier that 10 need to be done to adjusted after addition of tier 1 and tier 2. But now you have to do it under the common equity tier 1. So what happens? So what is the purpose? Can anyone tell, is it a good thing, bad thing, or whatever? So when you need to do in the common equity tier 1, what happens? You need to maintain higher or lower common equity tier 1. Higher. Because now, since these adjustments are also to be made in common equity tier 1, so bank need to maintain somewhat higher common equity tier 1. So that means what? The common equity tier 1 are the highest form of capital, highest quality of capital. So because of these deductions, you need to maintain higher and higher amount of much stronger capital. Okay. So that is very costly for a bank. Okay. Then, as I said, there are two buffers the Basel introduced. The first one is called the capital conservation buffer. Now, capital conservation buffer made up of common equity. So even here, you need to maintain common equity. and amount into 2.5% of risk-weighted assets. Okay, when fully phased in by 2019. So basically by now, because fully phased means earlier when Basel came into effect, the requirement was a gradual basis from the beginning in 2013, but now we are 2022. Now it is fully implemented. So basically now it's 2.5% across the board. So the purpose of this is to ensure on top of that, regulatory capital, you need to have an additional buffer for conservation. Conservation means, you can't conserve, you have to conserve capital at a good times. For what? To be used in the bad times. Okay. So when you are good profit, when you make good earnings, good profits, then build up this capital buffer in the form of common equity, right? 2.5%. So what does it mean? What does it mean? Now, what is with the buffer? How much a bank should maintain common equity, tier 1 and tier 2 with the buffer, conservation buffer? Tell me.
So, sir, the tier 1 must be 6 plus 2.5, 8.5. So that's
Sorry?
the tier 1 should be 6 plus 2.5, that means 8.5.
Yeah, common equity?
That is 8 plus 2.5, 10.5.
No, common equity tier 1.
The common one, 4.5 plus 2.5, 7.
7. So basically, now even though the normal requirement is 4.5, 6 and 8, with the buffer, common equity will be going up to 7%. Tier 1 will go up to 8.5. Tier 2, sorry, total will go to 10.5 because additional buffer. So that means with the capital conservation buffer, the bank is required to maintain common equity tier 1 capital of 7%. So it's almost equal to the earlier total 8%. So much stronger capital of 7%. Then tier 1 capital early only 4% originally. Now with buffer, it's going up to 8.5%. That means above the total capital at the original Basel 1 and 2. And the total capital move on to 10.5. Okay. So at the time of implementation, they also came up with a requirement that if a particular bank at that time, of course, this is not applicable right now. At that time, if a particular bank couldn't maintain around that 7% for the common equity, they were subject to some earning retention. Okay? They cannot distribute earning. But of course, now then, since we are in fully implementation, this is no longer valid, but now they must maintain 7%. So this is at that time when the Basel introduced this. Then the second buffer is the counter-cyclical buffer to reduce pro-cyclicality. So what is this? Now, in business cycle shocks, I think all of you know, we are moving in a business cycle. If you analyze the crisis, so you can see some crisis patterns. Okay. Now, if you look at 2007, 7 period, when before, what was the pattern especially in Western markets, especially US? What was the pattern you saw in the financial markets just before the crisis? What was the pattern of, like credit and all? What did you see around 2005, 6? Can anyone tell? So just before the crisis, you see there's a flooding of credit in the market. Credit has been flooded. Consumption has gone up. Excessive credit. by the financial system, mostly for the consumption, housing, and so on. So you see significant credit growth, credit expansionary period. So what does it mean? When you see over expansion, excessive credit growth, what is the signal? What is the signal? Well, we are going in a business cycle. That is common. Any market. Only question is the period. So cycle will break soon. Cycle will break soon. And then what happened? Turn into a what? Turn into one. What? Can someone tell? Cycle will break and turn into a recession. Turn into a recession. When it turned into a recession, what happened? What happened? From a bank's perspective, what happened?
Defaults will arise.
Huh?
Defaults will arise.
Defaults, yeah. Recession means business cycle become negative. So the people will find it difficult to sell their products. People, lose their jobs in a recession. People who obtain the loan cannot pay. So credit risk will go up, default will come, and banks cannot recover their debts. And banks are subject to significant credit risk. So that is the normal business cycle pattern. If you look at the numbers, you will see this in 2007 crisis as well. So that's why in many countries, whenever you see when there's an expansionary high credit growth period, generally regulators come up with some control measures. Okay, some control measures. So now, can you give some examples, such control measures? There are so many ways that regulators handle this. I mean, other than this counter-cyclical buffer, it came as a standard measurement. Can you tell any measures? Two measures, macro measures, not micro, macro. These are macro measures to maintain
Increase
the
of
mitigate.
reserve ratios.
Huh?
Increase of reserve ratios.
Okay, increase of reserve ratio, that is okay to reduce the monetary policy, but it's basically, yeah, one in a way. But more financial sector, that also can be considered as a monetary policy measure, but more specifically like banks, but from banking system perspective. Loan to value ratios, you bring in some loan to value ratios. Okay, that is something you can do. Credit ceilings, I think if you can remember, this was done in, I think, 2000, maybe 11 or maybe 12. Can you remember? 2012. This happened in Sri Lanka. Remember, after the end of the war, you see there was a significant growth of credit. So I think you should all know about it if you happen to work in the bank at that time. I think 2012 maybe. Remember, banks were given some credit limit. Beyond that, they can't go. So credit were limited. I think early 2012. I can't remember exactly. So these are some measures, macro measures to ease the over expansion in credit, which would be dangerous if it is go for a decision. So what the Basel said was, okay, whenever you see excessive credit growth in your sector economy, then introduce this counter-cyclical capital buffer to reduce pro-cyclicality. So the Basel gave a range 0 to 2.5%. So whenever you see, so it may be different from one country to another country. This is a national level measurement. National level measurement, either the central banks or the government should come up when they feel this is excessive. So that depends from country to country. So whenever the regulators or government feel, okay, we are running in excessive credit growth period, immediately they can impose this buffer on their banking system. Depending on the nature, the volume of credit growth. So maximum is 2.5% of the risk-weighted asset, again by way of common equity tier 1 capital. So that once you maintain this, let's say suddenly business cycle turn negative and you will face the recession. So what happened? Defaults comes, credit risk go up. Then whatever the losses can be absorbed by this buffer so that you can maintain the original requirement. So that is the idea, right? So this is called the counter-cyclical buffer. So let me move on to the original chart, which I want to show you. I said I will explain it later. Can you see the chart?
Yes, sir.
Okay. So look at common equity tier 1 capital. Now, under the normal circumstances, what is the common equity tier 1 requirement? Base value. What is the requirement? Normal requirement?
4.5.
4.5%. Then we have the conservation buffer 2.5%. 4.5 by 2.5 means 7. If a regulator impose counter-cyclical buffer due to credit growth, let's say maximum 2.5, then the capital common equity tier capital will go up to 9.5 in such period. Okay. Then tier 1 capital will go to 11%. So 6 plus 2.5 plus 2.5. Total capital will go to 13%, 8 plus 2.5% plus 3%, including both buffers. Including both buffers at a time when the regulator or the government decide to impose counter-cyclical buffer as well. But conservation buffer, you need to maintain at all times. But if the regulator decide to impose counter-cyclical buffer, so these are the ratios. 9.5 for CET1, 11% for Tier 1, 13% for total. So that brings a bank is adequately capitalized in terms of quality. In terms of quality to meet any risk arising in the system. Right? Any questions?
So this counter-cyclical buffer will be introduced to all the banks, no? Not like
Entire system, entire system.
entire system.
Because it is a macro measurement.
Okay.
Okay, macro measurement to curtail credit growth. Entire system. So the regulators decide what is the level. The max is 2.5% Basel III suggested, but it's up to individual regulators to decide what is the right amount for your country. It may be 2%, maybe 1.5, 1%, but max is 2.5%. So that will further add the strength to your capital levels and support any unnecessary risk as a result of credit growth. Okay. The final measure that Basel introduced is what is called the leverage ratio. leverage ratio. Now, as I mentioned earlier, the banks are the highly leveraged institutions. Unfortunately, people don't know about it. Now, usually, when a bank wants to grant a loan, one of the key indicators to a person or company, one of the key indicators, probably you, or one of the main or key indicators, probably a bank valuator will look at is what? There are so many ratios, but one of the main key, one of the key things bankers would look for. What's the ratio? Can someone tell?
DSC ratio,
Huh?
debt service cover ratio.
Yeah, debt service one, but yeah, that is right. But one of the another important ratio. That is also one. Another one, which indicate the risk. The debt service will tell you about ability to repay, whether your cash flows are enough. Okay, debt service ratio and cash flows are enough for you to repay the expected loan. But okay, particular ratio I want to tell is look at different thing. What is that ratio? It's already here. Leverage ratio, debt to equity ratio. Don't you look at debt to equity ratios before looking at anything else? Huh? Don't you look at debt to equity ratio of a borrower?
Consider it, sir.
Huh?
We consider it.
Yeah, so that is one of the key elements. What does it say? Whether already you are overburdened with the debt. Whether you are already overburdened with the debt, so that if I give a loan, is it possible for this man to pay? So would you like to have a lower debt to equity ratio or higher debt to equity ratio? Like to have in your company or borrower? What sort of a debt to equity would you like to have? Which one would you like? You are credit. I think most of you are in the credit area. It's a very simple question.
Lower debt to equity
Huh?
ratio. Lower
Sorry?
debt to equity ratio.
Yeah.
But if it is in an optimal point, that's acceptable.
Okay. So generally, you expect a lower debt to equity ratio that you are comfortable because the company or the borrower is not over, burdened with the debt. So that means his capital is somewhat comfortable compared to debt. Your debt to equity ratio is basically debt divided by capital. So higher the capital, lower the debt to equity ratio, lower the debt again, lower the debt to. So you may have a benchmark level, but you always would prefer to give a loan to a lower debt to equity. So, but if you look at your debt to equity ratio, how much? Your bank. How much? Worse than your borrower. Because 90% of your, what you call funding is by debt. Even deposits are debt. It could be short-term debt, long-term debts, even depositors are others' money. Debt means anything other than your equity are all debt. Right? So your structure is very sensitive in terms of debt to equity. So that Basel III said, okay, now you must also bring your leverage to a comfortable level. Okay. So Basel said, okay, they define what is called leverage ratio for capital adequacy related measurement as a capital adequacy measurement, said you must maintain your tier 1 capital. That is, okay, if I put this way, tier 1 capital divided by total assets. Now, total assets mean including both on and off balance sheet asset. Now, most of your assets are in the balance sheet. but there may be assets in the off balance sheet as well. So when your tier 1 capital divided by the total assets on and off, you may get a number. So that number is called the leverage ratio. So ensure that that is about 3%, at least 3%. So the leverage ratio acts as a non-risk sensitive. So you are not considering any risk, simple calculation, tier 1 divided by the total assets on and off balance sheet, to reduce the risk of accumulation of excessive leverage in the financial institution and in the financial system. So the total assets will be treated on a non-risk adjusted basis with limited or no recognition of collateralization or credit risk mitigation. So that is on gross basis. So you don't consider any collateral or anything. You don't net off. Gross basis measurement, and should be more than 33 times of the bank capital. Should not be more than 33 times of the bank's capital, or basically, in other words, more than 3%. Right? So this is called the leverage ratio. So this is the other measure the Basel III introduced, right? So if I recap the improvements in the capital, the tier 1 capital further divided into common equity tier 1 capital and additional tier 1 capital. And the ratios were common equity tier 1 capital, 4.5% of the total risk-weighted assets. Tier 1 increased to 6% of the risk-weighted asset. Total capital remained as 8% of the risk-weighted asset. On top of them, capital conservation buffer brought in, which is 2.5% of the common equity tier 1 capital. So with that, CET1 will go to 7, tier 1 will go to 8.5, total will go to 10.5. Then on top of that, when a regulator or the government feels there's a high excessive credit growth, they can bring in counter-cyclical capital buffer, which is ranging from up to 0 to 2.5%, depending on the need. If full 2.5% was imposed in particular country in the financial system, the common equity tier 1 will go up to 9.5, tier 1 will go up to 11, tier 2 will go up to 13%. So which will sufficiently covers any potential ability to absorb any potential. On top of it, the Basel III introduced this particular leverage ratio, which is tier 1 capital divided by total assets, including off balance sheet, that is on and off balance sheet assets, must be more than 3%. So that bank is comfortable meeting any present and future risk, both expected and unexpected. Any questions? So I will not go to the next one because we need some time, so I can start fresh. We have almost come to the 12:30. So I will discuss the direction issued by Central Bank of Sri Lanka for the domestic banks. So this will briefly explain what is happening in the capital adequacy framework in Sri Lanka. Some of you may already know. And so we will discuss in detail, and also I'll explain what are the different core capital element, supplementary capital element, how do we take the risk weights under the different methods, like standardized method we discussed. So we will look at it next day. So because it will take some time, and also we will move on to the last area of my, in the course relevant to myself. Any more questions before we close for the day? Anything you need clarification? Okay. So since there aren't any clarifications, so we will stop for the day, but be thorough with the principles behind capital adequacy framework, especially what is presently applicable. But think about how it evolved, because Basel 3 itself is an extension of Basel 2 in terms of the numbers only, but the process is same. There won't be any change in the process, but the numbers are a little bit different, enhanced, but it is basically Basel 2 with a upward revision for the capital standards with addition of certain buffers. So you should be thorough with what is pillar 1, pillar 2, pillar 3, different methodologies, not the technical side, but the background, okay, of each methodology. And then the pillar 2, the 4 principles, bank's own capital assessment, then regulator, how they look at it. Minimum capital should be below the minimum requirement, then how the regulator should take action on them. So these are the 4 pillars. Then about the new capital buffers, which I just mentioned. And then this last part, pillar 3, we will discuss next day. And also what is happening in Sri Lankan context with respect to the Basel 3 framework. So with that, we can conclude the session for the day. So we will see you next week, 8:30 Sunday. Thank you.